Well, hi there. My name is Jason Ayres. I'm a derivatives market specialist by designation. I'm a Montreal Exchange options instructor, and I'm also the Chief Executive Officer at the Croft Financial Group. And in this webinar, we're going to be taking a look at trading earnings using options with unlimited upside and limited downside. Now, in an effort to satisfy our legal and compliance departments, we just want to take a couple of seconds here to review the limitation of liability, which simply means that the information that we're going to be presenting here during this webinar is for educational purposes only. And we want to make sure that you understand all of the risks associated with utilizing options before you actually go applying these strategies live within your portfolios. Now, in today's webinar, we're going to be talking about earnings, risks, and opportunities. We're going to be looking at which strategies we can use to take advantage of these opportunities. We'll talk about earnings and how implied volatility relates to earnings and adjusts, expands, and contracts based on upcoming earnings expectations. And then we'll take a look at straddles and strangles, which are a couple of strategies that you can consider utilizing if you want to take advantage of an earnings opportunity. All right, so let's get into taking a look at earnings, risks, and opportunities. Now, one of the interesting considerations around trading an earnings report is that there's typically higher than expected volatility. And what this simply means is that you'll find a stock will generally move, not always, but quite often will move much more than it typically would move under normal trading conditions. And that really just simply has to do with the fact that stocks typically have all known information priced in. And when you're dealing with an earnings report, well, that can result in some price information that could force the market to make some pretty quick decisions, either buying because earnings were better than expected and there's future opportunity, or selling because earnings were not as good as expected and there is an expectation that the shares are going to drop significantly in value. So this often can create a surprise directional move. Now, if we take a look at an example here, I'm just using Canada Goose symbol GOOS on the Toronto Stock Exchange, and I've highlighted with green arrows just the points within the trading cycle of the stock where an earnings report has had a significant influence. And you can see that at the bottom where you have volume indicated, there's a little E, and that E represents an earnings report. And what's interesting is that you can see not only did the stock move significantly. In the first example back in November, it moved to the upside, but you can also see that spike in volume. And then you can go to just towards March there, and you can see it moved to the downside, again on significant volume. Pushing towards June, where you can see that other E, and it moved once again very significantly to the bottom on very high volume. And then subsequently, they're back just ahead of September, where you saw a little bit more of a mitigated move, but nonetheless a drop to the downside with a spike in volume. And so the idea around trying to find strategies to trade these earnings reports is really to attempt to take advantage of that significant increase in volatility or price action. The risk, of course, again, is that it could either be to the upside or the downside. Now, I'm going to talk about strategies that will allow you to favor one side versus the other, or in fact, just trade it neutral with the opportunity to take advantage of either direction. But nonetheless, the whole idea around trading an earnings report is trying to capture that significant move. All right, so the question becomes, which strategies can I use? Well, realistically, you can use any strategy that will favor a directional bias. So no different than if you thought Canada Goose, as an example, was going to go up on any given day and you were bullish on the stock, you could go long a call option or buy a call option. Or you could go long the stock itself and buy a protective put. Both of those strategies give you unlimited upside with a limited and defined downside. If you're bearish on the stock, again, no different than any other time in the trading cycle of the stock, you could be bearish and buy a put, go long a put option, and subsequently take advantage of a move to the downside. Or you could short the stock with a protective call option, and that's a strategy that we actually took a look at in a previous webinar, again with a limited and defined risk exposure and an unlimited profit potential. And if you're not sure, which is often the case because earnings can surprise, you can use a straddle or strangle strategy, which we're going to cover towards the end of our presentation. Now, one of the main considerations that we have to look at when we're trading an earnings report is the idea of implied volatility and how it influences the price of an option contract ahead of an earnings report and then after an earnings report has been released, because that actually can have a very significant impact on the profitability of the trade, as well as the management approach, how you manage the trade and manage your expectations around your potential profit if you're correct about a directional bias. And so with that in mind, there are actually two types of volatility that we can be considering. And this applies anytime. It's not just around earnings reports. So that's what I want to reinforce here as well. We're always considering volatility when looking at creating an options strategy around a trade opportunity or idea. But we're going to talk about it as it relates more specifically to earnings in this presentation. So again, two types of volatility: historic volatility and implied volatility. Now, historical volatility is the past realized volatility. It's quantifiable, it's measurable. It's measured by the average deviation of the share price from its average price. And that's a mouthful to understand, but really if you think about creating sort of a smooth line along the trend of a stock, many of you may be familiar with a moving average. And so let's say you plot a moving average alongside of a price chart of a stock. You'll see that the moving average, if it's, let's say, a 20-bar moving average, will sort of stay sort of relatively in between or in the middle of the price action of the stock on any given day. And you'll notice, though, from time to time, though, the share price will either be above or below that moving average, depending upon the price action of the security. And so if the security moves significantly within a day, then to the upside, then it'll be significantly above the moving average. If the share price is volatile to the downside, then it'll be below that moving average. And so really what historical volatility is measuring is quite simply how much the shares trade above or below that average. And this gives us an idea as to how historically volatile a stock is. Some stocks are much less volatile than other stocks, and so this actually has a significant influence on the value of or the pricing of an option contract. But more importantly, when it comes to the idea of an earnings report, we want to be looking at implied volatility. Now, implied volatility is the market expectation of future volatility in the underlying shares. It's a probabilities adjustment for the option price, and it creates what's known as a probabilities distribution curve. Now, I don't want to overwhelm everybody with math, but this really helps sort of conceptually understand how an option is priced. Because again, if you think about it in the context of probabilities, we want to recognize that market makers, those trading professionals that are behind setting options prices and then filling the various bids and asks and matching buyers to sellers, what they're trying to do is they're basically trying to price options based on the probability of whether or not those contracts are going to be in the money or out of the money on expiration. And so what happens is, depending upon market conditions and the market maker's ability to forecast probabilities, the option contract price will adjust accordingly. So let's take a look at it from the perspective of a normal distribution bell curve. So what we're looking at here is as I mentioned, a distribution bell curve. And the idea here is that, let's say these shares are sitting at $50. Under normal circumstances, the market maker or the market in general might have an expectation that the shares have a 68.2% probability of staying within that $45 to $55 range. And as such, because there's a high probability of that happening, those option contracts will be priced accordingly. And then the further out of the money options and the further in the money options, those contracts prices will adjust accordingly as well. But the idea is that the market maker is going to price the contracts, whether they're calls or puts, it doesn't matter, higher within that range. Now, when implied volatility expands, it's really based on the fact that there's a change in the environment. So in other words, there's a change in expectation for what the shares of the underlying security are likely to do. And what this does is it creates a period of anticipated high volatility. And what will happen is volatility will expand, adjusting the price of the options. Now, this rate of change measure is called the vega. So vega is that mathematical influence on the option premium, which we'll get into in another webinar down the road. But it's one of the option Greeks, and it's what's used to calculate that rate of change. So what ultimately ends up happening is the market maker then has to adjust the price of the premiums wider. So in this case, you'll see because of that change in market expectation, the market maker now is saying, okay, now the potential for the shares to either trade down to 42 or up to 58 while they're actually currently sitting at 50. So what they've done is they've forecasted an increased probability for more volatility in the shares. And what that means is that market maker, they're responsible for taking the other side of the trade. So they need to get compensated accordingly. So prices of those option contracts within that range will increase. And of course, if the market in general, you and I that are trading these contracts, feel that that's appropriate, well, heck, we're going to pay for it, right? And so you've got this situation where conditions begin to change. Option premiums begin to increase in value. So where does this tie into earnings? And I'm going to reinforce this again, but if you think about an earnings report as being sort of an unknown variable, right? There's a lot of uncertainty. We don't know what the CFOs or the CEO is going to come out and say about the company. What's their forward guidance going to look like? How did they do this quarter? What's their expectations for next quarter? It's a lot of uncertainty. So what happens is leading into that announcement, you'll see an expansion of implied volatility. And so you need to be aware of that, because as the option buyer, if you're considering participating in the opportunity, you're going to be paying more for that contract because of that uncertainty. Now, the challenge is that if you end up paying more for that option contract because of that uncertainty, but then the earnings announcement comes out and is not as exciting as had been expected, well, you're going to see a contraction of implied volatility. And that's where the environment changes, creating a period of less volatility. It's kind of like, think about buying hurricane insurance ahead of a hurricane. When you don't know where that hurricane is going to hit or what damage it's going to do, you're going to pay a lot more than after the hurricanes pass through, right? That insurance really has no value once that hurricane's passed by. So that's kind of how an option contract is priced in that sense. Is once the unknown circumstances pass by, then the environment changes, creating a period of less volatility, and you get a contraction of implied volatility, and option contracts will adjust lower. And so the market maker then will have to readjust all the contracts, and it may be such that they adjust down to a range, let's say, where the expectation is the shares are now likely to trade between 47 and 53 within a 68.2% probability. So a higher probability the shares are going to remain within that range, and then of course all the option contracts across the different strike prices and expiration dates will adjust accordingly. And so the risk here is that if we buy options ahead of earnings and we pay a high implied volatility premium for those contracts, and then the earnings release comes out and maybe the stock moves a little bit, doesn't matter up or down, It depends on our directional bias, of course, but maybe the stock moves a little bit in the direction we anticipated. It may not move sufficiently enough to compensate for the contraction of implied volatility. And so we need to make sure that we're taking that into consideration before we're actually transacting the trade. Now, let's take a look at an example here. So here is Aphria. APHA. This is an options chain reflecting Aphria options. Now, the date of when this example was taken was September 30th. And there is an earnings report coming out October 12th. So you can kind of see there's only 12 days, and that's really the important consideration here, not the time of year or what months they are, but there's 12 days ahead of expiration, or sorry, 12 days ahead until the earnings report. And what you'll see here is that this stock has a historical volatility of 49.9%. Now, keep in mind that historical volatility is a reflection, once again, of the actual price movement of the underlying shares. So because we're dealing with a stock here in the medical marijuana or the marijuana space, it's volatile. So it always typically will reflect a high historical volatility, and as such, those option contracts will always have sort of a perpetual high implied volatility factored in. But what I want you to take a look at here, more importantly, is with 12 days ahead of earnings, you've got a historical volatility of 49.9%. That's really what the stock has been doing. But you've got an implied volatility within the option contracts between 73% and 198%. So you can see options that are expiring after earnings. So in other words, people would be buying these contracts or even selling these contracts to hold through earnings. You can see that in the implied volatility column that the number is way off the charts comparative to the historical volatility that you'll see up in the top left corner of that header. And so to sort of visualize this a little differently, what you'll see is that you've got this expansion of implied volatility leading into earnings. And then once those earnings are released and the market has an opportunity to digest that information, well, what ultimately happens is you get this contraction after earnings. And if the underlying shares have not moved sufficiently enough to compensate for that, well, then you could end up making a lot less money than you anticipated, or in fact, be right about the direction, but find yourself in a losing trade because of this contraction. And so what I always like to remind folks of is that, we have the opportunity to create positions based on this understanding ahead of an earnings report. So we can actually take a look and we can recognize that, hey, maybe we want to prepare ourselves a month ahead of the earnings report, or a couple of months ahead of the earnings report, or maybe we want to create a strategy that will allow us to take implied volatility out of the equation, like a spread strategy of some sort or a collar strategy of some sort, so we can take advantage of a directional move, but not be impacted by the expansion and contraction of implied volatility. Now, I'll tell you though, the opportunity in timing your purchase of the option contract, whether it's a call or a put or a straddle or a strangle, is that if we can buy before implied volatility really starts to expand, not only do we have the opportunity to take advantage of the market direction, but we can actually take advantage of an increase in implied volatility. So the importance of timing is critical. The lower cost option gives us the chance to take advantage of an increase of implied volatility leading into the event, but also a significant price move in the underlying security. So we actually have the opportunity to take advantage of two important variables, putting those on our side just by having a little bit of an understanding of how implied volatility works when it comes to option pricing. All right, so I mentioned that you can trade earnings reports by simply buying a call or buying the stock and a protective put in combination to trade a directional bias to the upside. You could buy a put, or you could short the stock and buy a call to trade a directional bias to the downside. And in all of those considerations, you want to make sure that you're paying attention to implied volatility. Now, those strategies really allow you to take advantage of one particular directional move. So in other words, you're either bullish or bearish, and you're positioning yourself accordingly. Well, the straddle and strangle strategies allow us to take advantage of both directions. So we don't necessarily have to pick a direction in order to benefit from a significant move in the underlying security. So both these strategies have a number of characteristics in common. First of all, they involve the purchase of a long call and a long put option combined. So we are buying a call and we are buying a put in combination. In both cases, we expect a sharp, volatile move in either direction. So this is where we don't know. We're not sure whether it's to the upside or the downside. However, we know that it's going to move one direction or another, which lends itself very effectively to an earnings report, as I reflected on in the example using Canada Goose, where some earnings reports you had a big move to the upside, others earnings reports you had a big move to the downside. So the straddle and strangle allow you to take advantage of this. Now, these strategies are typically based on an event or an anticipated change. So in other words, earnings reports are a great example of where there could be some sort of material change in how a stock is traded, where it may influence it in one direction or another as far as the price action is concerned. Now, the trade-off here is that there's a higher break-even point because you are paying for two premiums. So let's circle back to the idea of where implied volatility comes into play. Remember that the environment changes, creating a period of higher implied volatility. So this expansion of implied volatility adjusts the price of the option contracts. And so the straddle and strangle can capitalize on this market condition, provided that we as the trader are actually paying attention. So if we recognize that this is something that we need to be considering, then we can actually go in and create the strategy ahead of when this expansion starts to take place. Because if not, we may end up overpaying for the option. So in other words, to consider going in and, buying a call or a put, or buying both in the case of the straddle or the strangle, the day before an earnings report, really you are pretty much guaranteed to be overpaying for the options contracts. It's like buying hurricane insurance, the day ahead of when the hurricane's at your doorstep, or buying house insurance while you've got a burglar in your kitchen. So we really want to make sure that we are a little more forward thinking in when we're positioning ourselves to take advantage of this opportunity. So let's take a look at the straddle. Now, the straddle is referenced as such because what we're doing is we are buying a call and a put. We are utilizing the same expiration, but we're buying the same strike prices as well. So we're straddling the same strikes. Okay, so an example here would be, let's assume we've got XYZ trading at $41.20. And you as the investor expect that there's going to be some volatility. There's an earnings report coming up in the next month, and you recognize that implied volatility is reasonable right now comparative to historic, and you want to capitalize on the potential of a large move. So you can go out and you can look at a 2-month 42 strike call option, and that's asking $1.10. You can then go out and look at the 2-month 42 strike put option, and that's asking $1.90. Now, the reason why that put option is a little more expensive is because it's slightly in the money. Recognize that the stock is trading at $41.20, and the 42 call is slightly out of the money. The 42 put is slightly in the money by about 80 cents. So you're always going to have a little bit of a differential between the call and the put when you're doing a straddle, simply because one may be slightly in the money while the other is not. Now, what we're going to do to create this strategy is we're going to buy a call and we're going to buy a put. So if we're looking to mimic a 1,000 exposure to 1,000 shares of the underlying security here, XYZ, we're going to buy 10 of the 42 strike calls, and we're going to pay $1.10 per share, or 110 cents per contract, or $1,100 for the position. We're going to go in and we're going to buy 10 42 strike puts at $1.90 or $190 dollars per contract, or $1,900 for the 10 contracts, with a net cost of $3 or $300 per straddle, or $3,000 for the 10 positions. Now, we need to recognize that we have two break-even points here, right? So we start to make money as the shares on expiration when the shares are trading below 39 or above 45 at expiration. Why? Because we have to take the net cost of the combination, and in the case of the upside, we need to add it to the 42 strike call, and in the case of the downside, we need to subtract it from the 42 strike put. So what happens is we get what's referred to as a risk-reward profile. So in this example here, what we can see is that profit at expiration is achieved provided that the share price is above or below the break-even points at 45 on the upside and 39 on the downside. Anywhere within that range, and the position is going to experience a loss. And the maximum loss occurs at expiration if the share price is exactly at the strike price of the call and put purchased, right? Now, what we want to recognize here, and I like to put things into the perspective of the actual share fluctuation of the underlying stock, because we only really want to apply these strategies to stocks where historically we've seen that they have potential to make a move. So you can see with this price chart that historically over several years that the shares have, over the course of a couple of months, moved significantly enough to achieve our break-even points, either to the upside or the downside. But you can see when we put things into perspective here, the current stock price is relatively close to where the strike prices are. And you can see the break-even point to the upside and the break-even point to the downside, which we would need to be above or below on expiration. And remember, the reason being is that both options, when we purchase them, are for the most part mostly made up of time value, which completely disappears at expiration, leaving only the intrinsic value of the option contract for us to profit on. And so that's where that break-even point comes into play. If we take that $3 and add it to the 42, the contract or the stock needs to be above 45 for the position to hold, for the call to hold a $3 intrinsic value and offset the loss in the put. On the other side of it, the shares need to be at least 39 to for the puts to have a $3 intrinsic value and offset the cost of the calls. Anything above or below those levels equals profit. Now, that being said, you can close the position out at any time. So if the stock takes off in one direction very quickly, you can actually close out one side and favor the other side if you feel that the stock's picked a direction and you want to ride that direction. So you don't have to necessarily hold completely till expiration. You can manage the position accordingly to your expectations as the stock starts to react after the earnings report. Now, the strangle is just another way to participate. So in this case, what we're looking to do is we're looking to buy a call and a put option. Again, exactly the same consideration. We're going to buy these options with the same expiration. However, what I'll suggest here is that you can actually create calendar straddles and strangles as well. So you can actually switch up your expiration dates. I don't want to overcomplicate things, but I always like to plant the seed that, you can, if you can dream it, you can build it, so to speak, as long as you work through the risk reward profile of the strategy. But the typical approach to straddles and strangles, as we're referencing here, have us using the same expiration dates, but you can switch that up if you think that there's an opportunity to do so. The only difference between a straddle and strangle in the case of this presentation is the fact that the strangle uses different strike prices. So instead of straddling a strike price, you're strangling it, I guess, is where that reference comes from. And the put has a lower strike price than the call option. So again, if we jump in and we take a look at this opportunity here, we've got XYZ trading at 41.20, so the exact same share value as our last example utilizing the straddle. Investor expects volatility, but we want, in this case, the investor wants to benefit from a large move in share value at a reduced cost. So this is kind of like buying out of the money options. And why would we buy out of the money options? It's usually because we think that there's going to be a substantial, significant move in the underlying, and we want to pay less for the option contracts because we're confident there's going to be a big move. So in this case, we're going to go out to the 44 strike call. 2 month till expiration, and that's asking 40 cents. So you can see significantly less cost than the 42 strike in the last example. The 2 month put at the 40 strike is asking $1. And so by going out of the money with our call and our put options, we've now reduced our cost quite substantially. So in this case, again, buying 10 of those call contracts to mimic 1,000 shares, being long 1,000 shares, 44 strike at 40 cents, right? $40 per contract, times 10, $400. And then times the $40 strike put, which is costing $1. And again, that's going to be $100 per contract times 10. It's going to cost us $1,000 for those 10 contracts to mimic being short 1,000 shares. Net cost is $1.40 per strangle, or $140 per strangle, or $1,400 for the 10 contracts. You can see what we've done is we've basically lowered our cost basis and our total risk exposure in half, in fact, more than half. Our break-even points adjust a little bit, and that's what's interesting about this consideration. The stock doesn't have to move that much more on expiration for us to break even. The break-even points here are 38.60. So what you're doing is you're adding you're subtracting $1.40 from the 40 strike put to find your downside break even, and then you're adding $1.40 to your 44 strike call to calculate your upside break even at expiration. Once again, what this does is it creates a risk reward profile. And what you'll notice here, very important, is that we've widened out the break-even range. And I think this is an important consideration here, because we've widened our strike prices out above and below the current share value. The shares, if they remain within a range, we will lose our entire investment. So that's the risk. We're putting up less capital, but if the shares remain in a range, then we end up losing the entire combination. So we profit at expiration provided the share price is above or below the break-even points, the exact same consideration, but the maximum loss occurs at expiration if the share price is between the strike prices of the call and the put purchased. And so you can maybe identify that a little bit more effectively by looking at the example using a price chart, where in our straddle example, the break-even point was fixed at the 42 strike. So right here, so anything above or below that, those option contracts would have intrinsic value, and we'd actually salvage some of the, some of our net capital allocation. But in this example here with the strangle, you've got the 40 strike on the downside. You can see the put strike there in the arrow, and the 44 strike, the call strike there you can see labeled within the arrow, and anything in between that, if the shares are in that range within the on expiration, the entire position will expire worthless, because again, neither one of those option contracts that we purchased will have made any intrinsic value. And so when we're looking at utilizing these kinds of strategies to trade an earnings report, it is critical that we get in and buy these options, buy the call and buy the put, when implied volatility is reasonably low, so that we can benefit from an expansion of implied volatility leading towards an earnings report. And we also have to be very confident and comfortable that there's going to be a significant move in the underlying security, and that the historical price action, as reflected here in this price chart, actually suggests that, yeah, the stock can actually move $3 within a month to so I can at least break even, right? Point being is that if you're looking at a stock and its historical volatility suggests that, look, on any given month, it's only moving $1 or $2 here and there, and it's never moved anything beyond that, even on an earnings report, don't create a strategy with a net cost of $3 if the stock's never moved that ever in its trading history, right? So you really want to be selective in that sense. And when you put that, sort of factor, in when you're considering the opportunity, it may actually force you to decide whether or not you may be just best to take a directional stance, just buy that call or just buy that put, or in fact, make an adjustment to your straddle or strangle position through strike price selection so that you can favor a direction more effectively. Now, what do I mean by that? Well, this is where we get a little bit more into the details of how an option contract is priced. So the delta of an option contract is in fact a reflection of the anticipated change in price of the option contract as it's influenced by a move in the underlying security. So the delta is a mathematical measure used to show the change in an option price relative to a change in the price of the underlying security. I know that's a mouthful, but remember, options are derivatives, right? So when the stock moves $1 to the upside or $1 to the downside, the option contract is going to increase or decrease in value, and again, depending upon whether or not it's a put or a call, by the amount of its delta. Now, a couple of key considerations as far as the option delta is concerned. Deeper in the money call options have deltas that approach 1. And call options always have a positive delta. So what do I mean by that? Well, as a call is deeper in the money, so there's less time value, delta is higher, and that means that that call option is going to be more sensitive to a move in the underlying security when it moves to the upside. Now, a deeper in the money put option, the delta will approach -1. So what does this mean? Well, that simply means that, again, the deeper in the money options have less time value, more influenced by the movement in the underlying security to the downside. So as the stock drops in value, it's more sensitive to that $1 move in the underlying shares, and the put option always has a negative delta. So how do we put that into play as far as our decision-making process goes when we're selecting strike prices for our straddles and strangles? Well, let's look at strike price selection based on the delta. So if we have a directional bias where we're neutral or we're not sure, what we're looking to likely do is we're looking to select a call strike and a put strike which have similar deltas. And an at-the-money call and an at-the-money put typically have deltas close to 50 or 0.50. So if we're looking to be more neutral, we can buy a call with a delta of +50. We could buy a put with a delta of -50, and you can see that we're in fact delta neutral. So we're starting this strategy out delta neutral, meaning that it doesn't matter which way the stock goes, we're going to start profiting on one side or the other similarly, and then those options will adjust accordingly as the shares move in that specific direction. So by matching the call delta to the put delta, which is readily available, you can usually see the option deltas in your options chains when you're selecting the option contract. But by selecting options, a call and put options with similar deltas, you're creating a delta neutral position. If you are more bullish, what you're going to look to do is you're going to look to favor the call delta. So you're going to buy a call with a higher delta, and you're going to buy a put with a lower delta. So in this case, what you're looking at here is if I buy a call with a delta of plus 65 or plus 0.65, and I buy a put with a negative 0.40 or 40, you'll see my net delta is plus 25. So what does that mean? Well, I'm more in favor of the upside. Now, these are examples. I could buy a call delta of plus 70 and a delta of negative 20, and that's going to increase my sensitivity to the upside for that net combination even more significantly. Right? So it all depends on how bullish you are in terms of your strike price selection. Now, if I'm more bearish and I want to favor the bearish side, again, I choose a call delta that's lower. So in this case, it's going to be an out-of-the-money call with a delta of plus 40 and maybe an at the slightly in-the-money put delta or put negative 6.5 or negative 0.65. You can see my net delta here is negative 2.5. So I'm favoring the downside. And again, I can adjust the call delta lower, so I could do something much further out of the money. So plus 0.20 and do a put delta further in the money, let's say negative 0.80, and I'll be even more skewed bearish for that particular strategy. So what that comes down to is you're creating a directional bias through the adjustment of your strike price selection, and you're using the other side, the other option contract, the call or the put, depending upon what your directional expectation, as just a bit of a hedge, right? And you're going to adjust your strike price selection based on your directional bias. But this is a really effective way to get in and sort of skew that directional bias while still utilizing the straddle or strangle strategy to play both sides, or effectively create a hedge where you've got limited risk on the downside, but unlimited opportunity on the upside from a profitability standpoint. So a few final thoughts here, guys, as we're wrapping this webinar up. For earnings opportunities, you can purchase a call or a put based on your directional bias. That hasn't changed. These are still great ways to participate based on your expectation. But the main consideration here in that approach to trading around an earnings opportunity is that you have to be cautious of the implied volatility factor. You want to put that expansion of implied volatility on your side by comparing current implied volatility of the option contracts with historical volatility and making sure that they're close. What does that mean? That means that you want to be forward thinking. So you don't want to be buying these options the day before an earnings report, because you are most certainly going to be paying options with a very, very high implied volatility factored in, and you then subsequently run the risk that once that earnings report is released, the stock may make a move one direction or the other, but it may not be sufficient enough to compensate for the contraction of implied volatility. So you have to be sensitive there. The other side of it is, or the other approach is that you can play both sides of it using a straddle or a strangle. So this is a great way to, if you're not sure which way it's going to go and you just want to position yourself in a more neutral approach, then buy the call, buy the put at the same time. Remember, straddle is where you're using the same strike price. Strangle is where you're using different strike prices to trade the opportunity. Again, same consideration for implied volatility applies, in that you want to be doing this a little ahead of time so that you're not getting, so that you're not paying that huge volatility premium. And then subsequently, if you want to adjust your positioning, your exposure, you can do so by adjusting your strike price selection and subsequently adjust your delta exposure. Remember, higher call delta, lower put delta means that you're favoring more the bullish side. Lower call delta, higher put delta means that you're more favoring the bearish side. So keep all of this in mind, guys. Earnings opportunities are a fantastic way to take advantage of a significant move in the underlying security. Utilizing options to do so is a great way to position yourself for the opportunity to generate unlimited profit potential with a limited downside, but you have to be cautious. You have to put some thought into when and how you position yourself to take advantage of these types of trades. Going forward, folks, we have one more chapter left in the series here. That's Chapter 6, Myths and Misconceptions of Options Trading. So make sure that you pay attention to the webinar calendar and sign up when this date is released. As always, there's lots of great information available on the Montreal Exchange website for you to further enhance your educational experience. One of the great tools available is the Options Play, which is a trade screener which will allow you to see a lot of these strategies that we've been talking about during this webinar series applied to real stocks that trade on the Toronto Stock Exchange. So it's a great way for you to review risk and reward profiles based on your objectives, whether or not you're looking to generate income or create a directional bias. You can screen for all of these various strategies as applied to your favorite options eligible stocks. As always, remember, this is for educational purposes only, so this is a great complement to these webinars that you've been participating in as you're enhancing your educational background on options trading. As always, thank you very much for joining in for this webinar. My name is Jason Ayers, Derivatives Market Specialist, Chief Executive Officer at the Croft Financial Group, and of course, an instructor for the Montreal Exchange. Thanks again, and we'll see you again.